Hello and welcome. Today we're diving into a really critical part of the new Income Tax Act 2025, Section 79. If you or your clients are dealing with unquoted shares, this section is something you absolutely have to understand. It completely changes how capital gains are taxed. So, let's break it down. All right, let's kick things off with a situation that I'm sure many of you have come across. Imagine you're selling shares in a private company. You agree on a price, the deal is done. But what happens if the tax authorities look at that transaction and say, hang on, we think those shares are worth a lot more? Well, that's precisely the scenario Section 79 is built for.
So, first things first, we're going to get straight to the point and decode the legal provision itself. Let's see what the law actually says, word for word.
And here we have it. This is the core of Section 79. In simple terms, if you sell an unquoted share for a price that's lower than its fair market value, or FMV, the tax department gets to ignore your actual sale price. For the purpose of calculating capital gains, they will use the FMV instead. Make no mistake, this is a very powerful anti-abuse provision.
Now, this is a fascinating legal concept. It's what's known as a deeming fiction. Basically, the law creates a sort of alternate reality just for tax calculations. You might have received, say, 100 rupees in your hand, but the law says, nope, for our purposes, we're going to deem that you received 150 rupees, if that's the fair market value. It's a really important idea to grasp. For all the seasoned professionals tuning in, this might be ringing a bell. And you'd be right. Section 79 in the new 2025 Act isn't a brand new concept. It's basically the next chapter for what we knew as Section 50CA in the old 1961 Act. The fundamental principle is exactly the same, which is great because it provides some continuity and makes the transition a bit smoother for all of us.
So, you might be asking, why does this rule even exist? Well, it's all about clamping down on tax evasion. The government wants to prevent situations where shares are deliberately undervalued, especially in transactions between friendly parties, just to lower the capital gains tax bill. Section 79 aims to stop that by introducing a standard, objective way to value these shares. Okay, so we've established that fair market value is the magic number here. But how on earth do we figure out what it is? Thankfully, the Act doesn't just leave us guessing. It lays out a very specific method, and that's what we're going to get into right now. There's a clear roadmap for this. The Income Tax Act itself points us in the right direction. It sends us over to the income tax rules of 2026. And once we're there, our destination is Rule 57. This rule contains the exact prescribed formula that we have to use.
And this brings us to the real engine room of the whole calculation, the formula itself. Honestly, if you're dealing with unquoted shares, this formula is something you're going to want to know inside and out.
And there it is. Now I know, at first glance it might look a little complex, maybe even a bit intimidating, but don't worry, we're going to break it down piece by piece. Understanding each of these variables is absolutely key to getting it right.
Let's decode this. A is the book value of your assets, but with some very important exceptions. That's where B, C, and D come in. For things like jewelry, other shares, or real estate, you can't just use the book value. You have to use their current fair market value. This gives a much more accurate picture of what the company is actually worth. L is for liabilities, again with some specific rules. And finally, PV and PE just help us portion all of that value down to a single share. All right, theory is one thing, but nothing beats a practical example to see how this all fits together. Let's walk through a case study to really see the financial impact of Section 79. Okay, here's our scenario. We have an investor selling 1,000 shares in XYZ Private Limited. The agreed sale price is 500 rupees a share, bringing the total sale consideration to 5 lakh rupees. But when we apply that formula from Rule 57, the fair market value comes out to be 800 rupees per share. So for tax purposes, the deemed consideration is 8 lakh rupees. Now just look at the difference this makes. On the left, based on the actual money received, the capital gain is 3 lakh rupees. But on the right, when Section 79 kicks in, the tax department starts with the 8 lakh FMV. The cost of acquisition stays the same, of course, but the taxable capital gain has just doubled to 6 lakh rupees. It's a huge difference. And that right there is the bottom line. In this one transaction, because of Section 79's deeming fiction, an extra 3 lakh rupees has been added to the taxable income. You can see how ignoring this provision could lead to some very serious tax consequences down the line.
So, we've seen how significant the impact can be. The big question is, how do you make sure that you and your clients are doing everything by the book? Let's talk about the practical steps for correct compliance.
Think of this as your essential checklist. First and foremost, you need a professional valuation report that follows Rule 57 to the letter. Timing is also critical. The valuation date has to be the date of the transfer. Keep every single document that supports your calculation. And finally, the most important step. In the income tax return, you must report the deemed value, not the actual sale price, if it's lower.
All right, knowing the rules is half the battle. The other half is knowing where people usually go wrong. Let's cover some of the most common pitfalls that can get you into trouble with the tax department.
Okay, let's run through these traps. A big one is using an old valuation report. It has to be current. Be super careful when calculating liabilities, the L&R formula. You can't just throw in contingent liabilities to lower the company's value. Also, for any property the company holds, you have to use the stamp duty value. And a very basic mistake we sometimes see. Remember, this whole section only applies to unquoted shares, not listed ones.
We've covered a lot of ground today, so let's just take a moment to boil it all down to the most important takeaways from this explainer.
So, let's recap. 1. Section 79 is an anti-avoidance law, plain and simple. 2. If your sale price is less than the FMV becomes your sale price for tax purposes. 3. That FMV has to be calculated using the specific formula in Rule 57. 4. Solid valuation reports and great documentation are your best friends here. And 5. For the veterans, remember, this is just the evolution of Section 50CA.
And I'll leave you with this final thought to take away. Take a hard look at your current processes. Are your valuations and the paperwork behind them strong enough to hold up if they ever come under scrutiny? It's a crucial question to ask.
Thank you so much for joining us for this deep dive into Section 79. If you found it helpful, we'd really appreciate it if you could like, subscribe, and share it with anyone else who might benefit.
And finally, just our standard disclaimer. Please remember, this is for educational purposes only and isn't professional advice. Tax laws are always subject to change, so please be sure to consult with your professional advisor before taking any action.